This is InvestTalk. Independent thinking, shared success.
I am calling about Power Solutions, ticker PSIX. Do you think it's a good company and now it's a good time to invest? Or do you think it's overvalued and ran up too much? Thank you. Bye.
Interesting. Okay. PSIX is the symbol. And this is a $1.4 billion market cap company. It's come a long, long way. For years, it didn't make money. And then it started making money in 2022, but really didn't break out until last year, about a year ago. And that's when it was trading around $2 per share. Now it's trading at $61 per share. So you can see that it has quite the run. Okay, and let's see what it does. It manufactures, distributes, and services power systems that run on non-diesel fuels, including natural gas, propane. Okay. And this kind of dovetails into our main focus point, which is how gas is powering AI, natural gas. And so this is very interesting. Okay, so I like the space that it's in. The big question is has it gone too far, too fast, right? So free cash flow right now is about 48 million. It has leveled out though. In fact, first quarter of last year, free cash flow was about 75 million. Earnings look to also be leveling out. Earned $2.81 last year. This year's supposed to earn $3.01. So 7% growth, good, but not incredible. Next year, 6% growth, $3.20. No dividend. Let's take a look if they have any debt. I don't think they do. Yeah, not minor, about $10 million in debt. Nothing crazy there. I have no issue with this. I kind of like it. It's not expensive, not cheap either. The technicals look fine. And so I'm going to give this one a thumbs up. Certainly high risk because it's just started to really make money. But I like the place that it's in. It's a bit overbought now. Obviously, a pretty decent reversal today. Looks probably ready for a pullback. But if this can pull back to $45, $46 per share from the mid 60s right now, or low 60s right now, I think that would be a good place to pick up PSIX, Power Solutions International. Thanks for the call. Let's go pivot over to a call from Chris in Maine looking at Cameco CCJ.
Yeah, hey, Justin. Thanks, as always, for taking my call. I was wondering if you could just speak a little bit about Cameco. I've owned it for quite a while, as I know you guys have as well. I actually sold about 30% of my holdings at 58, thinking it was a pretty unsustainable jump, and now here we are in the 70s, not long later. So I was just wondering what you guys, are you still just holding for right now, or are you guys trimming it all?
Yeah, we're still holding nuclear. We think it will continue to have a renaissance, and this is the most liquid way to play the space. Now it's been overbought. Probably needs to cool off a little bit, but I think it will continue to be a great place to have. It's a core holding, right? So if you want nuclear exposure, this is one of the cleanest, most liquid ways to play the upside of not only the price of uranium, but also Westinghouse. So they bought Westinghouse at a bankruptcy, and that if you're talking about deploying nuclear facilities throughout the world, especially here in the United States, then Westinghouse is a good way to get exposure there. So it's I have no reason to cut it significantly. Now, when it gets overbought like this, can it be prudent to take a few chips off the table? Sure. But I don't think there's any reason to wholesale sell it or take it down to a small percentage of your portfolio. I would continue to hold it.
This is Ray from Illinois. Very much appreciate the podcast and everything you teach your listeners. I have a question about fractional shares. A lot of the online brokers are advertising fractional shares. And I was wondering, from your standpoint, is there a downside in buying fractional shares versus whole shares? Just thinking in terms of investing in round dollar amounts as opposed to specific number of shares when buying and selling stocks. If you could let me know, I would appreciate it. Thank you.
Put simply, no, there's not really any downside unless there's some additional costs for the broker. I haven't seen that. I don't see that. I think it's just a feature they've rolled out where you can buy fractional shares. Now, I don't know how they do that kind of behind the scenes, but yeah, I think it's a great way to gain exposure to companies that, especially if you have a small dollar amount and you can't afford, especially from a diversification standpoint. It used to be, if it's a $10,000 account and I go buy a company that's trading for $1,000 per share, and there's plenty out there, and a lot of them are cheap, even though they look $1,000 per share. You might sounds like a lot, but remember, it's always in relation to earnings and cash flows, et cetera. So, they have to buy one share, and that might be 10% of the portfolio, and that might be too much. Now you can buy fractional shares, buy 0.1% of a share, and now that's only $100. Now it's reasonable as a percentage of the overall portfolio. So I think it's great. I think it's outside of free trades, it's probably the next best thing the brokerage community has rolled out over the last 5-10 years or so, is the ability to buy fractional shares. I've see no downside to it, at least from my point of view. And it's a good way to kind of accumulate shares, companies you might like, and not have to worry about it becoming too much of your portfolio. So great question, and hope that helps. Let's go take a live call. Jay from Ohio looking at General Mills. Dave from Ohio looking at General Mills, GIS.
Hi, Justin. Hey, do you feel the dividend is safe? I know it's a downward motion, and they've been losing market shares. But do you feel that the 5.5% dividend is safe at this time?
Put simply, no, I don't. I think General Mills is a classic value trap. Everyone knows their brands, Cheerios, all the cereals. They have yogurt brands. I believe, what was it, Dannon? Let's see, Betty Crocker, Blue Buffalo, Haagen-Dazs, Nature Valley, etc. Tons of large brands. Problem is debt. Said this many times. When you have a lot of debt, it doesn't matter how good your brand is. If you're losing your cash flow is declining, earnings are declining. It is, the stewardship of the brands here is just not good. And frankly, this is a business that is becoming less and less popular. There's younger generations don't want to buy this stuff. They don't want to buy packaged foods. They want fresh foods, or they want smaller niche brands, organic brands. They see these brands as old and unhealthy, and people don't want to buy them. And that's why you saw last quarter revenues were down 3%, earnings were down 27%. The quarter before that, revenues were down 5% year over year, earnings were down 15% year over year. And this year, earnings are expected to be down 6%. And guess what? That is declining in its expectations as well. So, analysts continue to see earnings headed lower. And now, while I think they'll probably pay their dividend in the short term, I don't think it's going to cut like imminently or anything like that. I just think the broader trends in the industry and for this stock, right? There's a reason it's struggling dramatically. The market is starting to price in an increasing likelihood that General Mills is just headed for bankruptcy. Now, it doesn't look like in the short term, it's probably not going to file for bankruptcy this year, maybe not even next year. But when you have just continued deterioration in the business and you have a lot of debt, it's going to struggle. And this is not the type of name that you want to own. This is a classic value trap, down another 4% today, a new 52-week low. Let me look here at a weekly chart. Yeah, I mean, I got to go to a monthly chart to find the last time General Mills traded at these levels. It hasn't traded at these levels since 2020. Okay. And this is below the now the 200-month moving average. I think this is a classic value trap. I would not own it.
Thank you.
Thanks for the call. Now let's talk about gold. And there's a recent report coming from the European Central Bank, and it shows that the gold has overtaken the euro as the world's second most important reserve assets for central banks, driven by record purchases and obviously prices going up. Gold accounted for 20% of global official reserves last year. So this is the end of 2024. And the euro is now down to 16% of global reserves. The dollar assets at 46% of global reserves. So still about half of what dollar assets are. But central banks continue to buy at record paces. Central banks, for the third year in a row, acquired more than 1,000 tons of gold last year. That's a fifth of total annual production and twice the annual amount in the decades of the 2010s. And now we're starting to get back to levels that we haven't seen since the 1960s. Central bank gold reserves peaked at 38,000 tons in the mid-1960s. Then we went off the gold standard for the US dollar in the early 70s. And now we're back to 36,000 tons as of the end of last year. So we're almost back to peak, which was mid 1960s. The largest buyers, India, China, Turkey, and Poland. Now last year, the price of gold was up 30%, and it's already up 27% this year. So you add record buying on top of two back-to-back great years for the price, and that adds up to a huge chunk of the central bank's asset pools as in gold. And investors are starting to look at gold not as a hedge against inflation. That's what it used to be. Gold's a hedge against inflation. No. Now it's the ultimate safe, highly liquid asset. And it's not exposed to counterparty risk or sanctions. And that's really the story here. Ever since the start of the Ukraine war and the fact that the US just decided we're going to confiscate Russia's assets. We don't like what they're doing, so we are going to confiscate their treasuries, their dollar-denominated assets, anything that's within the SWIFT system, etc. Other countries have taken notice, especially those that are not US allies, or traditional US allies. And they're saying, hey, why are we putting money in the dollar, putting assets in the dollar? Let's go buy gold. That is becoming the de facto reserve asset. And a survey among 57 central banks that were holding gold last year said that their concerns were sanctions, expected changes in the monetary system, and a desire to become less dependent on the dollar. Those are the main drivers of continuing to buy more and more gold, especially those countries geopolitically close to China and Russia. And then on top of that, investors are starting to look at this as a hedge against political risk and geopolitical risk. So, it's clear that this is a new era. It's a new regime for gold that was ushered in after we confiscated the assets of Russia during the initial invasion of Ukraine. So that is a huge story. That's a big reason why I think the durability of the bull market in gold remains. And it's until really these central banks shift gears or they've had enough, right? But I'm not seeing that. I don't see any incentive for them to slow down, to change. It's all going to all those assets that used to go into the dollar, thinking that, hey, we want deep liquid asset pool. They're less focused on that. They're more focused on the stability of the assets that they are owning and the lack of connection to the United States and our sanctions. There's another question. submitted through our online web form over on investtalk.com. Tyson says, what is your current assessment of Lulu? I'm considering adding more to my port position at these levels. I love the company and its products. I know the tariffs have heavily influenced the company's earnings estimates. That being said, this recent pullback seems like a good buying opportunity in the $230 range. Would love to hear your thoughts. Well, this is a name I've actually been looking at over the past couple of, let's call it last year, after it dropped from a high around 500. It was way overpriced then. That was early 2024. And then it fell recently to a low around 230. And I was thinking about buying it. We didn't fire on it. And then it quickly moved up to around $400 per share. At that point, it was overvalued, especially compared to roughly $14 it earned last year. So, I wasn't going to pay a 30 multiple for something like that, roughly. And I wanted something that was more discounted. And now it is. It's down to 230. It's back down to those levels, and it's trying to find support here. But the more I've studied this name and the trends within this industry, the less I've liked it. Mainly because, I don't know about you, if you go look at what the younger generation is wearing. And you tell me how many of them are buying tight-fitted clothing. It used to be, athleisure wear, and it's still a thing. It's still popular. Problem is, it's becoming less popular. And there's more competition. There's especially more competition from online brands. Obviously, I remember when the tariffs started and the Chinese factories came out on TikTok and said, hey, you can go buy Lululemon leggings for $5 directly from this site, as opposed to, $100 at a Lululemon store. And I'm just seeing not a lot of great trends that are going to hold Lulu's business up at this level of profitability. Now, I think there'll still be a leader for a long time. I still think that the athleisure, there still will be a segment of demand there, especially, those that maybe grew up over the last 20 years. And now they're in their maybe late 30s, 40s, 50s, and they still love their athleisure wear. And I think that there's going to be that segment. Problem is that I think the younger generation doesn't have that excitement for these type of brands, that type of athleisure wear. And you're seeing that in the profitability. Earnings are actually supposed to be flat this year, up 8% next year. But if I go over to, I'm pulling up my FactSet database here, and I'm looking at earnings trends from earnings history. And recently, as of March, it was supposed to earn $15.38 this year. Now it's down to $14.62. It's declining. It's been on a decline really for a little while now. And I'm not liking that. So far this month, 25 analysts have downgraded earnings estimates. 3 have kept them flat, and only 4 have increased them. So I don't like the earnings trends here. If I go look at the chart, once again, it is hitting this 230 level. It's much more reasonably priced now than it was, but it's not at a level quite yet where I'm getting excited about it, right? If there's no growth, well, I'm going to pay low teens, maybe multiple going forward. If that. Okay, so if it earns $14 again, what are you going to pay? Maybe 175, 200 in that range. That's where I would maybe be interested in it again. But I still don't love it. I don't like the technicals. I don't like the broader trends in the name. And so I would pass on Lululemon. I'm still watching it, but I'm not liking what I'm seeing at the current moment.
Hi, Luke and Justin. Matt from Minneapolis calling here, longtime listener here. I currently own XHB, and it hasn't done much at all over the last couple of years for me. I'm considering dropping it And what I'm looking at is a Vanguard Coinbase ETF that I've led to believe, besides just Bitcoin and that, it has lots of stocks and good quality ones in it. So I'm considering buying some of that. What are your thoughts and opinions of getting into an ETF that concerns Coinbase? Thanks. I'll be listening on the line.
Okay. I would love to know what Vanguard Coinbase ETF. I'm not, that's my issue, is I don't know exactly which ETF you are talking about. Now, one question would be really around what type of exposure you already have to crypto, to Bitcoin, etc. Now, XHB is certainly struggling for good reason. It certainly is dealing with the higher interest rates. We just talked earlier in the day about how the new home sales surprised the downside. And one issue with XHB is that it's not just home builders. If you buy ITB, that's just home builders, but XHB has home builders along with names that supply home builders. I believe names like Home Depot are in there, etc. So it's a bit broader. You might want that, you might not. But the point here is that, I don't see this as a bullish place to be in the shorter term. Now, crypto has some longer term tailwinds, but it's certainly high risk. And I say that because it's highly driven by liquidity. And right now we're in a fairly abundant liquidity environment, although that is likely to slow in the back half of the year. So I'm not very bullish on Bitcoin, say, end of third quarter and into next year. Near term, I think it can be okay. I think it could maybe even head up to 120, 130, potentially. But what is interesting to me is that it's kind of lost its momentum, right? It's moved up to around over $100 per coin in May. And it's been just dropping sideways for the past 2 months and not really breaking out to the upside when it was just should, right? It's making new highs and should clear the resistance and really, really break out. It's not really doing that. So I don't get excited about buying here because I think you want to be accumulating Bitcoin when it has its winter. Well, and it always has that. It always has its 60, 70, 80% drop from its highs. Now that high could be higher than it is here. But the point is, most likely the next Bitcoin winter will drop Bitcoin well below where it is sitting today. And I would rather accumulate during those periods as opposed to right now, which is, kind of neutral to bullish in the short term. So frankly, I don't get excited about either one of these. I think there's better opportunities elsewhere. I would just keep looking, frankly, for names that give you better exposure to sectors that are much stronger. I think industrials continue to do very well. Parts of the technology area continue to do well. You have consumer defensive, consumer staples. There are pockets there that continue to do well. Financial services with a steepening yield curve. I think those areas are seeing some tailwinds. And then harder assets, basic materials, parts of the energy space, talked about natural gas, et cetera. I just think there are a lot of other opportunities out there in the short to medium and long term that I would rather pick up right now. That about does it. I'm Justin Klein. It's another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. Be sure to rate and review on iTunes as well. And if anything about today's show made you think about your own financial picture, your investments, your taxes, retirement planning, right? Think of Social Security planning, Roth conversions, healthcare expenses. What about your will and trust, etc.? All these things are what we help our clients with. Navigate these environments, not just the investment side. Certainly that's heavier part of our lifting, but it's not the only thing that we do for clients as well. So if you need help with any of it, just schedule a no-cost portfolio review with me or Luke by heading over to investtalk.com. Click on the portfolio review button. Independent thinking, shared success. This is InvestTalk. Good night.